Hello, class, and welcome to our sixth lecture series on financial accounting or principles of accounting. And I'm your instructor, Dr. Jamel. Okay, so in our previous lecture, we have talked about the adjusting entries, and we talked about what are the types of adjusting accounts and how are the process of that one. So we decided that the type of account that basically we need adjusting entries. So these are prepaid expenses, depreciation, accrued expenses, accrued revenue, unearned revenue. So those who already watched our lecture 5, so they already know that what are these accounts and which basically balance sheet or income statement account these belong. So basically prepaid expense is our asset, right? Whenever we consume our assets, we need to reduce that one. It means prepaid expense is our asset, and when we use those assets, for example, prepaid rent, still we need to use that rent whenever, for example, prepaid rent is for 3 months. So if you consume rent of 1 month, so it means 1 month rent will go to income statement as an expense. So that's why when you consume that, the adjusting entry would be against expense, right? So entry would be prepaid expense to prepaid account, like for example, the rent expense to prepaid rent, right? Similarly, the depreciation, it is the usage of assets. It's not the reserve account. It's not something that you can use it and you can just collect some reserve and replace the asset. No, this is just the depreciation, the wear and tear of the asset through its usage, right? Basically, depreciation is contra account, which means opposite of the asset account. So its normal entry would be reverse entry. So if asset increase, we make it debit, but if accumulated depreciation increases, we make it credit, because this is the opposite of the asset account, right? Similarly, accrued expenses, what does it mean? Accrued expenses means expenses occurred but not paid. For example, employees work for you for the whole month and you didn't yet pay their salaries, because salaries are normally paid on specific dates. For example, first week of the month, or every 15 of the next month. So it's like that. So whenever the official contract of salary is fulfilled, so that salary will transfer to liability, and when you pay, then you decrease that liability. So the concept of debit and credit is the same. We make a journal entries, we post them into a ledger accounts. The concept is the same, just you need to pay close attention to these adjusting accounts. How much salary is now payable? Did we pay the salary according to the date or not? If not, it would be a liability. If paid, then liability gonna decrease. Accrued expenses. Oh, accrued revenue. What does it mean? It means you already sell the thing, but you did not receive the money. It's like credit sales. So in that case, you create account receivable, and account receivable are our assets, right? Customer purchased goods from you but didn't pay you. So we create customers account receivable, right? So that is called accrued revenue. So normally we don't write accrued revenue, we just write revenue, that's it. So for example, Miss Ella purchased supplies from on account. Entry would be Miss Ella to, entry would be supply increases. Oh, sorry. We sell goods to Miss Ella. Entry would be Miss Ella to sales. So that is basically accrued sales. So normally the books, they don't write this word accrued. So you automatically assume that it is either a cash sale or either accrued sale. But whenever this is unearned revenue, It means you don't have the right to record it as a revenue, because what is the process of sales? When goods are officially transferred to the customers, when ownership is transferred. So in that case, ownership is still with you, unearned. So customer paid you in advance, goods are still in your possession, and you didn't transfer it. So it means ownership is not transferred, so you don't have the right to record it as a sale. Matching principles, right? So recall our lecture 5, and if you have some kind of, any difficulty, please revisit the lecture 5 links, or you can just post in our WeChat group. I would be happy to answer over there. Okay, so let's move forward. So we are now applying all those adjusting entries to our illustration here. Okay, let's go for this illustration. So Friday's Auto Service Incorporation would make an additional adjusting entry to accrued income tax expense 600 and the related income tax payable as the final adjusting entry for the period. So basically, the income tax would be, what is the entry? Basically, entry would be, now since there is accrued expense is our liability. That expense is not paid, expense occurred but not paid, so we make it as a liability. So entry would be income tax expense to income tax payable, right? Expense to liability, income tax expense to income tax payable, right? So these are all the the illustration in a nutshell in this table here. So all the entries here, like prepaid rent expires 1000, entry would be prepaid rent credit, rent expense debit. Entry would be expense to asset, which is rent expense to prepaid rent. Supplies used 300. It means there was a supplies like wrench, tape, stationeries, pen. So now how many pen, stationery, and wrench and all those stuff tools are used? Worth of $300. And entry would be supplies expense to supplies. Right? So the concept of debit credit is the same. Asset increase, debit, asset decrease, credit. Right? So when supplies are being used, asset decrease or asset increase? Asset decrease. So that's why supplies are on credit side. And when expense increase, debit. So supplies expense to supplies, right? Similarly, the depreciation on equipment, 400. So depreciation expense to accumulated depreciation, 400. So if you don't understand this depreciation stuff, don't worry about that. We are going to have complete chapter on depreciation in our coming classes. So don't just worry about too much right now at the moment. What does it mean? Is the contra account, opposite entries, and all those stuff. So don't just overburden yourself. Okay, now accrued salary expense 900. Accrued salary, right? Salaries occurred but not paid. Similarly, salary expense to salary payable. Amount of unearned service revenue that has been earned, 200. It means customer paid you in advance, but now what happened? You delivered those services. So it means now liability has to decrease. The question says amount of unearned service revenue that has been earned. So previously it was liability, unearned revenue was our liability, now liability decreased, debit. So that's why unearned revenue to revenue, right? The last would be accrued income tax expenses. 600. Similarly, accrued expenses, income tax expense to income tax payable. So any question up till now? These are just for the revision from our last lecture. Ella, Marilyn, Pinyo, Nam, Harry, Anthony, Hunjun.
No questions.
Anthony?
No question.
Okay. So now it's time to, generalize the entry. So we generalize the entry, and now the next step would be making T accounts or ledger. So all you have to do, post it into ledgers. We know how to post it. We already done in our lecture 4. So here we go, right? And how the balance is going to be calculated. Whichever side is greater than that one, the balance is going to be written on that side.